Wealth Monthly Market Commentary. My name is Hillary Sunderland, and I'm Chief Investment Officer at Beacon Wealth Consultants. And the purpose of this segment is to provide you with some talking points about what's been going on in the market and how that may be impacting your portfolio. And certainly with the month of October, we have a lot to talk about. So let's jump right in. Okay, so October was a bit of a volatile month. This chart shows the S&P 500 index, which is one of the major market indices that we look at to see how stocks are performing over a given period of time. And the yellow bar on the right side of this chart, that's where October began. As you can see, we had quite the large drawdown in October, almost down to the lows witnessed in the spring of this year, the February-March time period, when we had some volatility there as well. And the interesting thing is there's really no single catalyst for this decline in the markets. The economic news that we have has still been very good. GDP is still strong. Inflation is in check. Jobs growth continues to be good as well. And so there's really nothing wrong from an economic perspective, but the drop occurred really on a few different points. The first is that the markets had a bit of a delayed response to the recent rise in interest rates. And there's little sign that the rise in interest rates will be abating anytime soon. And the concern there is as bonds become more attractive, that makes stocks less attractive. So that hit markets over this month. There's also been concern about the impact of tariffs. We had a lot of earnings announcements over the last few weeks. Earnings have generally been very good, but forward guidance, which means what they think is going to happen next year, that's been, some companies have said that the tariffs are starting to impact the price of their input costs, and there's concern that in the future, earnings growth may start to decline. So that's hit markets a little bit as well. And also we breached what are known as key technical levels. I think that the decline, though, to put it into perspective, I think it has felt a lot worse than it's actually been. This chart shows 1%, the number of days in the last 5 calendar years, including a little bit of this year as well, where we've seen drops of at least 1% in the S&P 500 index. And the interesting thing is that in the preceding 3 decades, there have been 1% drops in the S&P 500 index every 7 or 8 trading days. But in 2017, a drop of at least 1% occurred on only 4 days of the year, which was extremely low in terms of volatility. This year, through October 31st, we've had a drop of at least 1% on 22 trading days, which, as you can see from this chart, 2018, now we're not done with the year yet, but it's fairly in line with what we've seen over the preceding 5 years. So really, I think what's happened right now to a lot of investors is 2017 was such an easy year to make gains, and the markets didn't really move to the downside very much at all. And so this year, when we've had 2 bigger downdrafts now, that's really causing a lot of angst for investors. I wanted to show you this chart because this is over the long term, the S&P 500 index since the market bottom in 2009. And I just highlighted a few areas there in yellow of different market declines in different time periods that were quite volatile for investors. But as you can see, it's still on a long-term upward trend. And these market declines do happen at times. It's a very normal part of investing. On average, you get a decline of a correction, which is defined as a decline from a peak of at least 10%, on average at least once per year. Now that does not mean that you get one every single year. It means that on average you get one per year. So it does happen at times. It's always unnerving when it does, but it is very much a normal part of investing. So how bad was October of 2018? Well, it was a bit gut-wrenching. The S&P 500 index, which is a measure of large cap stocks that are based in the US, it was down 6.84%, the yellow bar there. Small cap stocks, these are your smaller companies, were down 10.86%. International stocks, the gray bar, were down a little over 8. Fixed income, so bonds, were down 0.79%, and commodities are down a little over 2% as well. So your major asset classes here, what we saw in October was, while there was some buffer from fixed income for your more conservative investors, that asset class still declined in October as well, which I know has been frustrating to many investors. So let's talk about, what does this actually mean? Do we see a bigger bear market coming or not? And the interesting thing is that if you look historically, since the early 1900s, and you're looking at different bear markets. So a bear market is defined as a drop of at least 20% from a market high. And bear markets are what can really hurt your overall financial plan and your well-being. These shorter term drops of 5 or 10%, unless the client makes a big change in their overall accounts, it usually does not impede one's overall financial plan or their progress toward their financial goals. However, bear markets can hurt that because they can be very long. So the interesting thing on this chart is this shows all of the bear markets going back to the 1920s. And the interesting thing here is that most, but not all, bear markets are accompanied by a recession. There's only two there, the ones I have highlighted in red, the flash crash of 1962 and also the crash in 1987, where we had declines of over 20% and we did not have a recession with it. Now, the reason why I bring that up is because historically, the bear markets with the steepest decline and the longest recovery periods, so the ones that are hardest to recover from a financial planning perspective, are usually accompanied by a recession. And right now, the leading economic indicators are still very good. We still have strong GDP. We don't really see a recession in the cards anytime in the next 12 to 18 months. Now, if the trade war really heats up from here, that could change things. But as things stand right now, we don't see a recession on the horizon, and therefore we aren't too concerned about this latest market downdraft. We actually welcome it because as active investors, this is where we're able to scoop up opportunities in the market. So earlier this week, we rebalanced all the portfolios to try to take advantage of some of the declines that we had in stocks over the last month. And we saw a lot of indicators pointing to that this particular downdraft was very overdone on many levels. And so while we may see a little bit of a bumpy ride from here, we do have midterm elections in just a few days. And it does not mean that, the market's going to recover fully over the next few weeks and it'll just be a V shape and we'll be back to where we were in a few weeks. The odds are that this was more of a short-term setback in the markets. And so I wouldn't be too concerned of it at this juncture. We do actively manage the portfolios. We look at these every day. And so if something were to change with our thesis, we'll make changes to the portfolios as we need to. So year to date, where are we? The S&P 500 is up a little bit. It's up about 3%. And this is through the end of October. All the other indices I mentioned before, small cap domestic stocks, international stocks, fixed income, and commodities, they all have negative returns year to date. So it's been a tough year to make returns. We're coming off of some very strong returns in 2017. We're getting later in the bull market. And so at this stage in the cycle, it does become more and more difficult to earn really good returns over time. But this also goes in cycles. One of the things I want to point out here, this is a very busy chart, I know, but what it shows is different asset class returns since 2003 over different calendar years. So to explain this quickly, if you see something in orange there, that's small cap domestic stocks, the light purples, emerging markets. But what I want you to zone in on here is the fixed income, the light blue. So if you look at 2008, which is the sixth column over from the left, you'll see that bonds were up 5.2% in 2008. And whatever's on the top of the chart, that is the best return for that calendar year. And whatever's on the bottom row, that is the worst return for that calendar year. And the thing to note here is that it's easy to see visually with how the colors change is that asset classes change in terms of their leadership over time, and what is leading the market higher in one year usually is not leading the market higher in the next. And what is the worst performer in any given year usually isn't the worst performer in the next over longer periods of time. The white there in the middle with the line going through it, that's an asset allocation. So that's a diversified portfolio. So the point of diversification is that over long periods of time, because you're invested in broader asset classes, a range of asset classes, and they're periodically rebalanced and reweighted in your portfolio, over longer periods of time, that tends to smooth out returns for investors, which is a good thing. So even though fixed income has had a tough year for conservative investors, those tough years have happened before. Look to 2005 on this chart here, or 2013 when fixed income lost 2%. 2014, it was up 6%. It was the third best asset class. So just because something is a little downtrodden today does not mean it will be in the future. There have been some unique things going on with fixed income this year. And ultimately, rising interest rates are good for investors because it helps you to earn a higher total return over time. So it's one of those, it's just a process of short-term pain for longer-term gain there. And that's what we're going for. The other thing, just to mention here in terms of diversification, because I know that a lot of clients have been frustrated by, domestic large cap stocks are the only, one of the only asset classes that have positive returns year to date, and everything else is negative, including international. The thing to remember is that diversification works over long periods of time. And I think a lot of people look at their accounts at a particular point in time, and they forget that the diversification works over longer periods. I think this chart from JP Morgan is great because it shows over longer periods of time how diversification works in your favor. So that even though if you look at your account today and you're concerned that we may have an allocation to international stocks and international stocks haven't been doing well year to date, there's a reason for that. So the green here on this chart shows the S&P 500 index, and the top number on each bar is the highest calendar year return to the lowest calendar year return, and really that range that you see. The blue shows bonds, and then your gray bar is your 50-50 portfolio, or if you just take 50% of your portfolio and you put it in stocks and 50% of your portfolio and you put it in bonds, what does your range of returns look like over any given time period? So you can see here over a 1 year time period, historically, and this goes back to 1950, so the last 67 years is how this data is pulled. So a 50-50 portfolio has ranged from either 33% to the positive in any given year to a negative 15%. Okay, so that's a fairly big range of returns. But if you look over longer periods of time, so 5-year rolling periods, which is the second chart there, the second part of the chart, 10-year rolling periods, and then 20-year rolling periods, what you'll see is that over longer periods of time, you have less volatility with the gray bar. Okay, there's a little bit less upside, but there's also a lot less downside. And your average return over the last 20 years is 9% for a 50-50 allocation. So even if you're looking at your portfolio as of the end of October, and we've had a rough month, take heart, because diversification works over longer periods of time. And especially after large market dislocations like we have, that tends to shock your portfolio the most. And so I would just encourage all of our clients just to give this some time. We rebalanced the portfolios earlier this week. We're making changes as we see fit. And from an economic perspective, things still look stable to positive for the next 12 to 18 months. And so we aren't concerned at this time. But we thank you for your continued confidence. And as always, please reach out to us with any questions you may have.